Are you feeling the pinch of rising petrol and food prices? Well, I am, and I'm sure you're too if you're handling your household budget. Now, this is inflation we are dealing with, and the concept of inflation is rather simple. As prices of goods and services continue to go up, the purchasing power of mine and your money decreases. Now, your money buys you less tomorrow than it would today. And if your salary isn't keeping pace with the rising prices, you're in effect taking a pay cut. Cut to the chase, and almost all investment advisors are now talking about rejigging savings and investments to hedge against inflation. Today on the Property Show, we look at the impact of inflation if you're in the market looking to buy or invest in real estate, and we'll also thrash out whether real estate is really a good hedge against rising prices with Sanjay Dutt, MD and CEO of Tata Realty, Gautam Saraf, Managing Director at Cushman and Wakefield, and Harikesh, Ananthamurthy, Real Estate Consultant. Also on the show, India's first net zero energy project by Mahindra Eden, which has been launched in Bengaluru by Mahindra Life Spaces. Now, what does net zero energy mean for people who will buy and live in such a project? Arvind Subramaniam, MD and CEO, will decode that for us. But first, over to inflation. Sanjay, Gautam and Harikesh, thank you gentlemen for joining me. Sanjay, let me just come to you first. And you know, everybody is now asking that question, is real estate really a good hedge against inflation?
Manisha, real estate is an excellent hedge against inflation on three fronts. One, look at the land valuations this country has seen over last several years and continues to grow, whether there is a recession or whether there is a boom. In fact, in boom, it accelerates. Second, look at the cost of construction materials. We've been talking about steel, cement, all metals, for example, which go into the construction of the buildings or houses. They have gone up substantially. So if you buy a property and if you have the right location, you actually considerably hedge against inflation, because it will be impossible to build a house or an apartment building at a cost that you did just a few years ago. In our case, just 2 years ago, we were 15 to 20% less cost on real estate vis-a-vis today. And if the uncertainty of the war or indeed the pandemic or the disruption to the logistics and supply continues, God knows where it will end. So I think it's a considerable hedge in these times specifically.
Gautam, what's your view? I mean, it's not that clear a picture. Hedge against inflation, yes. What I'm hearing from Sanjay is that the replacement cost of building a house maybe next year would be higher with land prices and input prices going up. But there's also a question of how much inventory is available, how many goods of a particular kind are available in the market, isn't it?
Yeah, thanks, Manisha, and agree with Sanjay's point of view was more on the replacement cost. Now, it's a very old age adage that real estate is a hedge against inflation. Three primary factors that drove it earlier continue to drive it today. When inflation comes in, real estate prices move up, which is capital value appreciation. Your rent moves up, which is your return on investment. And your loan to value, your equity goes up, which is devaluation of your mortgage. Now, this is leading to the advent of multifamily coming into the country when it comes to the rents moving up. So we saw that in the Western countries, we saw that happening in China. We are seeing that happening gradually in India, where developers, institutional capital will build to rent. If you look at it historically, real estate, the consumer was buying to own, and he was betting against the capital value appreciation. Yield was not the play.
Okay. So, yeah. So yours, all right, that's another interesting point. Let me come back to that one a little bit later. Harikesh, you'd agree with this? Both the replacement cost theory that, you know, it's costlier to build a home tomorrow than it would be yesterday. And the construction industry is facing quite a pressure on costs. Do you think that at least home buyers should lock in their new purchases sooner than later?
I would say that home buyers should lock in the purchase sooner than later. just because of the fact that the cost pressure is on the developers right now. And I don't think they can hold on to prices anymore. At some stage soon, they will have to start raising the prices. And once they start the prices, it will be increasing for quite some time to come. And hence, it's a good time to buy real estate right now. Having said that, I think the prices increase will not continue for beyond a medium term, let's say end of this year or 2023 beginning quarter, just because the fact that interest rates also will raise simultaneously. That does two things. One is that the expectation from analysts at least is that over this year, RBI will increase the repo rate by at least 1%, 0.25% each RBI policy month, and over the year about a percent. Now this does two things. One is it puts pressure on the builders as well on terms of project financing, and therefore that cost pressure also comes along with the inflation on the cost of materials. So on the second side, the consumer is going to face higher interest rates, home loan rates. I think this will also lead to pressure on the pockets of the people. Whether they can affordability will start coming down is the question that we'll have to watch out.
All right. Sanjay, I'm going to pick up from where Harikesh is left, and that was going to be my next question. So, you know, now if you're hearing the conversations on a business channel today, stock market analysts are all urging people to stack up on some real estate quality stocks. And if you look at all the top line companies or big companies listed, whether it's Shobha, Brigade, or you have even a macro tech developers, which is Lodha, they've been reporting really sales which, you know, historically are touching some high number, depending on how long they've been in the business. If the interest rate cycle changes and the fact that developers cannot keep prices down for very long and prices start going up, which means affordability starts coming down, do you think the sales velocity of these companies will be affected by the end of the year?
I don't think so, Manisha. Two reasons. One, the inventory of residential units has come down in last 2 years, and also the launches have not gone up in last 2 years. They may go up now, but earlier they did not. Second, the inventory of developers has come down, Manisha, interestingly. So there are not that many developers that they were at least 5 years ago. The other interesting aspect that I wanted to add to my earlier statement was inflation is a precursor to rise in prices, Manisha. And it's, you know, barring some global disruption which adds to inflation, which is partly the reason for this time. But let's look at the reason why prices go up. Prices generally go up because there is much higher job confidence, much more recruitments and hiring across IT or other sectors. There is a propensity to pay, and after pandemic, people want to enjoy more, and they want to invest in a good quality backed by a reputed developer in a good location. So with these number of launches low, developers limited, and many of them not being able to bounce back, even though the markets have bounced because they don't have access to capital, I don't think this will be the case. And you know, Manisha, we've been in this country where we have used to higher interest rates and we still bought properties. It's just that last few years we had a good run.
Okay, then how do we play out that number? Because, you know, the headline number on inventory overhang, which is the unsold number of units across the country. Of course, Delhi NCR tops the chart there with 48 months. But even then, we are at a number of 7.5 lakh units, Sanjay, which has actually gone up from the last year, January to March quarter. So I understand maybe 50 to 60% of this inventory is really those endlessly stuck projects, you know, that 4.5 lakhs which are just not getting completed. But still, I mean, if you look at the Mumbai market, there's a huge supply expected to come this year. Sanjay.
Manisha, there is a concept called relevant supply. You know, if you pick up the commercial, inventory, it will show 19% vacancy. And the moment you apply filters of SCZ, B grade, C grade, the actual vacancy in BKC will be 3%. or Cyber City will be like 4%, or Embassy Golf Link will be 0%. So it is, or Taramani in Chennai would be actually, less than 5%. So, but overall 19% scares everybody out. In the residential, barring few micro markets, whether it's Dwarka, whether it is certain locations where or Thane in Mumbai, where the supply is high, most other markets where you actually want to live or which is relevant supply, it's not that much, Manisha. That's my takeaway.
Okay. Gautam, just Sanjay's already alluded to what I was going to come to, which is India's office assets, which now anybody can buy quality assets through the 3 listed REITs. Those are the real estate investment trusts, which is Embassy, Mindspace and Brookfield, and all 3 are outstanding developers with a very good quality portfolio. How do REITs behave in a rising interest rate cycle? Because, most of these have actually seen phenomenal stock price rise in the last 6 months, anticipating a return of people to offices and maybe inflation as well. But the yield goes down. The dividend yield which they will declare now will be slightly more modest. So how do you play the REITs investment from now on, going forward?
So before that, on the residential front also, just one more data point, which is the top 11 listed developers had a 14% market share pre-pandemic, which is now at 21%. So this is, alluding to the fact that Sanjay was mentioning, there is a flight to quality. There are certain pockets which will always throw in supply, but there is a demand for grade A. Jumping onto the REIT aspect of it, 3 primary factors. In a REITed or any commercial real estate portfolio, there is a healthy 10 to 15% churn, which allows the developer or the REIT itself to do a mark to market.
Okay.
Corporates are not spending money in terms of capex.
So Gautam, sorry, just to interrupt you, mark to market means that the owner can reprice the rents, isn't it?
Yes.
He can raise the rents in an inflationary environment. All right. We are on NDTV 24/7. We have to just remember the audience.
The second aspect is, of course, when it comes to REIT, there is an input cost which goes up when it comes to labor, when it comes to fuel, which is geopolitical tensions, which are leading to input cost of maintenance going up, which for a REIT is also a pass-through cost. So a tenant or an occupier pays for rent and maintenance. Maintenance is never fixed. It is basis the input cost rising. The yields are calculated basis the net rent which the REIT earns. The third aspect is the new construction that is coming in, where the input costs of commodities, whether it's cement, steel or oil going up, it's already factoring in the inflation that is impacting it.
Okay.
So the impact to the REIT is possibly minimal with the inflation.
With the inflation, so good asset to diversify with. Harikesh, would you want to add to that? I mean, if I was looking to rejig my portfolio to, and I'm not a home buyer, but I'm just an investor, do I buy into a REIT? Do I buy into a real estate stock? Or do I actually go ahead and invest in a physical, maybe residential or commercial property?
I would hesitate to put money into REIT simply because of the fact that yield expectations will go up with the interest rates going up. And if you see the lease expiry period for the REIT assets or the vacancy left with them or the new development coming, I don't see much scope for increased rental to come in. The mark to market that Gautam talked about is relevant when a lot of vacancy comes up and those can be leased out. But that's not the situation with the current REITs in the country. And therefore, I think it will be difficult for them to meet the reset yield expectations that will come in. And that definitely come in. In my opinion, REIT should behave as bond. It should be inversely proportional to the price being inversely proportional to the increase in the rate.
Okay, Sanjay, quick take on REITs. If you can just give me a very quick take. We've run
I think it's a good instrument if you're comparing to owning a hard commercial asset, because it's better managed, better risk mitigated, and institutional occupiers, which drive 80% of the demand of the office market, they prefer institutionally backed property assets. So you're in safe wicket. If you want higher returns because of inflation, you're worried about it, go and invest in equity markets and some other asset classes.
Fair enough. That was a very interesting discussion. Gentlemen, thank you very much for joining me. And of course, we'll see you soon on the property show sometime. When we come back, we look at Mahindra Eden, a premium residential project launched in Bengaluru by Mahindra Life Spaces. And the reason we are putting the spotlight on it, this is India's first net zero energy project, promising to save 18 lakh kilowatt electricity annually. That is equivalent to powering over 800 homes.